Hi everyone. In this video, I want to go through with you how to prepare a cash flow. In the past, I would have done a video on how to prepare cash flows, and I would leave a link in the description for you. That one was very basic and it didn't include any type of movements in the balance sheet other than your regular basic movements from one period to the other. So in this video, I want to show you how to deal with certain movements that can present a challenge if you're unfamiliar with preparing cash flows. So let's get right into it. Let's compute the movement in our balance sheet areas. Let's cut it from here. Put it on our cash flow tab. We cut it so that the cells would continue to link to the balance sheet. Let's copy the description and drop that on our cash flow tab. And let's get rid of all these excess spaces. Right, so from here, we're going to move out the cash balance, put it underneath. All the other asset balances, we're going to multiply that by -1 so we can change the sign. And then if you have a overdraft balance, you're going to move that out as well. And you're going to change the sign on this one. So when I add all my movements down, I'm going to come back to the movements in my cash and my bank overdraft. Good. So next step is to understand what caused these movements, so we'll know how to present them on our cash flow. It's always a good idea to prepare your cash flow last, because then you can use all the other notes to compile your cash flow figure. So let's get started with PP&E. If we go to the fixed asset note, which most financials have, we're just going to extract the movements, paste them across here. It's always good to paste links so that if anything changes on your tabs and in your notes, it'll automatically update. You'll notice that this adds to positive 200 because things like additions are at positive value, whereas additions on your cash flow is a negative value. So you'll notice it adds to 200,000, but your actual movement is minus 200,000. So we're going to have to change the signs. Yeah, and that's fixed asset sorted. The next one is right of use asset. So right of use asset, sometimes you might not have all your notes prepared. The easiest thing to do in that case is to have a look at how your balance changed from the opening to closing, ensuring that your opening balance matches your opening balance on your balance sheet, which is prior year's closing, and ensuring that your closing balance matches your closing figure on your balance sheet, which is current year's balance. So once you do that for all the different analyses that you'll have to do to prepare your cash flow, you'll be able to link it very easily. So for right of use asset, we're just going to grab these figures, drop them here, these links, and then we're going to do the same thing. I'm going to change the sign like that. And now we're going to go into investments. So we're just going to check it. It matches. Next we have investments. Again, just make sure the opening and closing matches what's on your balance sheet tab. And then you can pull the movements into your cash flow. Paste links. And again, we're going to change the sign. Okay, so now just checking back it matches before we move on. It does. So we don't need to do any further analysis of AR because there's actually a line item on the cash flow for change in accounts receivable. It's working capital, so we're going to leave it. We're not going to analyze taxation because we're going to total up all our taxation balances and we will add it to our cash flow as taxation paid. Right. So our change in share capital, change in revaluation reserve, and our change in retained earnings. So all of these you can pull from your statement of changes in equity. Let's grab these from here. Oops. There we go. So this comes down here. Right. So 50,000 increase in the valuation of property, plant and equipment, change in fair value, retained earnings, that ties back. So we're going on to liabilities now. So we're just going to put borrowings together and we're going to put lease liability together. Let's see if we can have a look at these movements. So we're going to go to borrowings. Again, just make sure that your opening and closes matching your balance sheet. And we're going to take these figures, movements, and we're going to drop them here. So the movements is minus 30,000, which matches the movement for your cash flow. Lease liability, it's on the same tab as the asset. Again, just going to pull this across. Good. We're making sure it matches. 12,000, 12,000. Great. Taxation, we're not going to worry about, as I said before. And trade payables, there is a line item on your cash flow for change in trade payables. So the last thing we need to really analyze is this line here called total comprehensive income that we got from the statement of changes in equity. We're going to have to break that down into profit before tax and taxation charge because those two balances are presented separately on the cash flow. So let's do that now. Great. Right, so what we have here is the framework for our cash flow. All these items here are going to make it onto the face of the cash flow except a few of them. We're going to go through them now. For example, the increase in PP&E because of revaluation is not an item that you'll find on your cash flow, but if you'll notice, it cancels off against the change in revaluation reserve. So it nets off to zero. So we're just going to put that in gray so we know we don't have to move these balances onto our cash flow. The other item that will net off would be, for example, your change in fair value. That will also net off against the change in the reserve. Another item that will net off that you probably won't think about right away is your new lease addition. Your right of use asset is not an actual purchase. It's just a computation that is done to present value of future lease payments. So because it's not an actual cash flow, it won't appear on your cash flow statement, but it will cancel off against your new lease liability. Because at the start of a lease, your right of use asset will match your lease liability. So these are the items that cancel off the cash flow, and therefore the rest of items we're going to take into our cash flow now. So based on the movements in the balance sheet that we've analyzed here, I've gone ahead and I have entered some line items that you're going to find whenever you have these type of movements. So let's go through them now. Profit before tax, depreciation and amortization, we had that during the year. Gain or loss on disposal because we had a disposal of fixed assets. Interest expense and interest expense on borrowings and leases. That's coming straight from our P&L item. We'll go into that just now. Working capital changes, increase and decrease in AR and AP because we had AR and AP. I also added a taxation net paid or refund line because we did have taxation balances during the year. I added an item for purchase of fixed assets because we had an addition, disposal of fixed assets because we had an addition, purchase of investments, disposal of investments or sale of investments, and of course lease payments because we did have a lease and we did make payments during the year. Under financing activities, I added in the issue of share capital. I added in dividends paid because we did pay dividends during the year. We had proceeds from loans received and loan repayments. I know I paid dividends during the year because as at year end there was no dividend liability. Yeah. So I'm just going to start to plug in these balances now. So I've scanned my cash flow. I don't think I'm missing any other items, so I'm just going to start adding them in. So we're going to start with profit before tax. And then we have depreciation and amortization. Charge for the year, amortization. And then we're going to jump over these for now, because we're only looking at the items that are in this framework. Because this doesn't pull from our balance sheet movements, it pulls from the P&L. We're going to jump over it and get back to it later. Changes in AR, change in AP, taxation paid or refund. So we're just going to add up all the movements in the taxation balances. So we have deferred tax, taxation payable, there was a taxation recoverable, and of course profit before tax, taxation charge. And then we're just going to add up all of these and come up to our net cash from operations. Next we have purchase of fixed assets. It's going to be purchases, additions. Disposals, we're just going to pick up this figure and this figure for now. Now it's proceeds from disposals and it's negative, but we still have some changes to make here. Again, for now we're just plugging in the balances from in the framework. Purchase of investments, maturities, and lease payments. So then we're going to have total cash flow from investing activities of 322,000. And now we're moving on to financing. So we're looking at proceeds from issue of shares, dividends paid, loan received, principal repayments or loan repayments, not principal repayments, loan repayments. So that's a total cash flow of 57,500 from financing activities. So our net cash movement, just based on this framework alone, would tie back to 30,000 because we're just picking up the figures that we've analyzed. So our opening cash is gonna go to the balance sheet. We're gonna pull a prior year cash figure. We're gonna minus the overdraft. So closing cash, we add these two together, is 10,000. Because it's made up of a cash balance and an overdraft balance, we're going to have to show it at the bottom of the cash flow. We're going to show cash and cash equivalents and bank overdraft. It'll be negative. And it matches back. So now we're going to have a look back now and include the non-cash items from our profit and loss account. Now, as it is right now, our cash flow balances, because we've picked up all the movements from the balance sheet. So if we're adding in any items on a profit and loss account, we have to take it out somewhere. And I'll show you what I mean. So gain or loss on disposal of fixed assets. On my P&L account, that's a gain. So I'm going to have to take it away. I'm going to have to minus it out of my profit to take it out to represent the actual cash movement. So because it's a gain, it increases profit, but it's not a cash movement, so I have to take it back out. Now, if you notice, I added here, but because it's a P&L movement, it's not taken from in this framework, you're going to notice that it's off. So in order for it to balance my gain on disposal, I come to my proceeds from disposal of PPE, and I minus it there. So now it balances. And if you'll notice, proceeds is now a positive figure. The next item is interest expense on leases. Again, a non-cash item. So I will come to the P&L and I'll have to add it back. So this is leases, right? Interest expense leases. So because I put it in here, it's off. So now I have to take it out from lease payments. And the rationale is that these lease payments here that we're pulling from this figure is actually only principal repayments. So for us to get the total repayment, we have to add up the principal and the interest. So that's why logically we'll have to add back in the interest portion at the bottom here. So we take it out up here, we add it in down here. And it once again, it balances. Similarly, borrowings. I have to take away loans. So I'm adding that back in because it's not a cash item. But then I have to include it in my loan repayments here. So I couldn't include all the possible movements that you would find, but you'll find that similar cash movements are treated the same way, and similar movements and balance sheet items are treated the same way. So for example, if you had a gain on the sale of investment, a realized gain on sale of investments, then you will treat it in very much the same way that you would have treated the gain or loss on disposal of fixed assets. It's the same concept, it's the same logic. So you'll add it in and you'll take it out from proceeds on sale of investments. So one thing I noticed I did not include is interest receivable. So if you'll bear with me, I'll pause the video and add that now. So now to show you how we'll treat with interest receivable, I went ahead and took out 5,000 from accounts receivable and added a line for interest receivable. And you'll notice now that our cash flow is off by 5,000 because I haven't yet added in this line item here. So I'm going to put that in now. There's a balance called interest received that I've put into investing activities because we did receive interest during the year. I'm going to plug that in there. And then I'm going to go to my P&L. I'm going to take away the investment income that's on my P&L because it's a non-cash item. Usually it's interest accrued. And then if I put in a figure up here, I'm going to come down to interest received and take it out so that it will continue to balance. So I know it's a lot to take in, but I hope that you learned something. I hope it clarifies some stuff, and feel free to reach out in the comments if you have any queries and any questions, and if you would like to see any additional videos on any particular topic. Thanks, enjoy.